Stocks, buying, selling and researching. When you purchase a stock or sell it, it is called trading stocks. Before you buy a stock you need to research the company. Most of this information is available for free. However, for a fee, there are services and brokerage houses that can provide you with the tools you need to make your decision. There is no one single proven method for investing success. One method many investors have found success in is identifying and investing in companies that offer both strong growth and high value and then holding onto the stock for the long term, which can vary from 3 to 10 years, assuming the company's fundamentals and performance remains the same. Most financial advisors also recommend that you have a diversified portfolio which produces better than average total return on your investment. Buying stocks, information is the key. Research is the key to finding a good company to buy into. You need accurate information and then know how to interpret it. You not only have to find out information about the company, but also its competitors, and the industry it is a part of. You have to investigate the companies, their historical performance and current performance and try to look for clues for its future performance. Companies operate in the world around them, so you have to look at the larger picture too. You really should understand the companies you invest in. For example, you should know what the company does or makes. You should be able to explain how the products or services are used, and who the buyers are. You should be able to explain what their competitive advantages are. Make sure to keep a watchful eye for not only news about the company but also its industry and competitors. Finally, keep tabs on what other market analysts are saying about the company. A buy recommendation from them can cause the stock price to increase, while a sell recommendation generally forces prices down. Corporate reports, financial statements and balance sheets. One source of information about a company is from their own financial reports and press releases. The best places to obtain these are either directly from the company itself or company's website or governing bodies for stocks in your country. Annual report to shareholders. O provides a financial statement and balance sheet for the previous year. Management will highlight their successes and some things that may not have worked out as planned. They will also discuss changes that they might make to improve their performance. Footnotes often hold interesting pieces of information. Quarterly report to shareholders. O shorter than the annual report, but contains much of the same information. It is also called the earnings report. This keeps you abreast of the latest changes and the company's financial performance. Current reports. Oh, these are released if a company has a major announcement they think shareholders need to know about. This could be a bankruptcy, merger, acquisition, change in top management, etc. Selling stocks. You do not want to buy or sell every time a stock goes up or down because then the only one who profits are the brokers on commission. However, you need to realize when it is time to get out. Here are just a few things to look for. Fundamental change. Are the profits and earnings not as high? Are they still a leader? Is their balance sheet as strong? See some of the above items. Is the company going in the same direction, or is management changing course? Dividend cuts. Dividend cuts are generally a sign that a company is in financial difficulty. What are other people saying? Are the news and analysts' reports as favorable or are they getting negative publicity? Slow growth. If the stock is not moving, growing slower than it has historically, you might be wise to sell and reinvest in a stronger security. Overvalued stock. When stocks soar quickly past their real value, they are often being set up for a fall. If you have made a profit, cash it in. You can always repurchase the stock. Keep an eye on the industry and its leaders. If you have purchased one of the top leaders in a growth industry and the other leaders are starting to slow, it might be time to get out before it happens to your company. The same holds true if the industry is slowing. Here are two strategies some investors use when it comes to selling shares. Set a target price. When you purchase a stock, set a target price to sell both on the upside and the downside, either taking a gain or cutting a loss. Sell in stages. Some people will sell part, for example 50%, of the shares of a company if it goes up a certain percentage, say 25%. This way if the stock reaches your sell stage percent, you will walk away with some profit. Calculating your return on your investment, ROI. We all want to say at the end of the year how much money did I make. But many investors do not look at the total picture. Many investors incorrectly state the difference between the buy and the sell price. For example, you purchased $500 worth of stock at $25 which equals 20 shares. You sold it a year later for $30 a share, so you earned $100 as profit. This equals a 20% return on your investment. $500, original investment, divided by $100, profit, equals 20%. However, what if the stock also pays a yearly dividend of 5%? Which means you would also receive $1 per share. So if you had those 20 shares for the year, you would also receive $20. Now your total profit is $120 or a 24% return on your investment. $500, original investment, divided by $120, profit, equals 24%. You need to count your dividends even if you reinvest them. You also need to subtract your broker's commissions and fees. Finally, you need to calculate your taxes on your investments. So the real return on your investment is calculated as ROI equals profits plus dividends, commission/fees, taxes.